Today, we will talk about the 5 Cs of credit, what they are, how they're used, and which is most important. The 5 Cs of credit are an important system used by lenders to gauge the creditworthiness of potential borrowers. The 5 Cs of credit is a system used by lenders to gauge the creditworthiness of potential borrowers. The system weighs 5 characteristics of the borrower and conditions of the loan, attempting to estimate the chance of default and, consequently, the risk of a financial loss for the lender. The 5 Cs of credit are character, capacity, capital, collateral, and conditions. The 5 Cs of credit method of evaluating a borrower incorporates both qualitative and quantitative measures. Lenders may look at a borrower's credit reports, credit scores, income statements, and other documents relevant to the borrower's financial situation. They also consider information about the loan itself. Each lender has its own method for analyzing a borrower's creditworthiness. Most lenders use the 5 Cs, character, capacity, capital, collateral, and conditions, when analyzing individual or business credit applications. Character, the first C, more specifically refers to credit history, which is a borrower's reputation or track record for repaying debts. This information appears on the borrower's credit reports, which are generated by the 3 major credit bureaus, Equifax, Experian, and TransUnion. Credit reports contain detailed information about how much an applicant has borrowed in the past and whether they have repaid loans on time. Prospective borrowers should ensure that credit history is correct and accurate on their credit report. Adverse, incorrect discrepancies can be detrimental to your credit history and credit score. Consider implementing automatic payments on recurring billings to ensure future obligations are paid on time. Paying monthly recurring debts and building a history of on-time payments help to build your credit score. Capacity measures the borrower's ability to repay a loan by comparing income against recurring debts and assessing the borrower's debt-to-income ratio. Lenders calculate DTI by adding a borrower's total monthly debt payments and dividing that by the borrower's gross monthly income. The lower an applicant's DTI, the better the chance of qualifying for a new loan. You can improve your capacity by increasing your salary or wages or decreasing debt. A lender will likely want to see a history of stable income. Although switching jobs may result in higher pay, the lender may want to ensure that your job security is stable and that your pay will continue to be consistent. Lenders also consider any capital that the borrower puts toward a potential investment. A large capital contribution by the borrower decreases the chance of default. Capital is often obtained over time, and it might take a bit more patience to build up a larger down payment on a major purchase. Depending on your purchasing timeline, you may want to ensure that your down payment savings are yielding growth, such as through investments. Collateral can help a borrower secure loans. It gives the lender the assurance that if the borrower defaults on the loan, the lender can get something back by repossessing the collateral. The collateral is often the object for which one is borrowing the money. Auto loans, for instance, are secured by cars, and mortgages are secured by homes. You may improve your collateral by simply entering into a specific type of loan agreement. A lender will often place a lien on specific types of assets to ensure that they have the right to recover losses in the event of your default. In addition to examining income, lenders look at the general conditions relating to the loan. This may include the length of time that an applicant has been employed at their current job, how their industry is performing, and future job stability. Conditions are the least likely of the 5 Cs to be controllable. Many conditions such as macroeconomic, global, political, or broad financial circumstances may not pertain specifically to a borrower. Here are 5 key takeaways. 1. The 5 Cs of credit are used to convey the creditworthiness of potential borrowers, starting with the applicant's character, which is their credit history. 2. Capacity is the applicant's debt-to-income, DTI, ratio. 3. Capital is the amount of money that an applicant has. 4. Collateral is an asset that can back or act as security for the loan. 5. Conditions are the purpose of the loan, the amount involved, and prevailing interest rates. Hope this would help. Thanks for watching.